on energy and the Saudi Aramco story. Let's bring in Tom Petrie. He's the chairman of Petrie Partners, and he has led teams that have advised the Kingdom of Saudi Arabia, the state of Alaska, and the U.S. Department of Energy. Tom, thank you very much for joining us today.
Good to be with you.
Let's talk first of all about Saudi Aramco. I know this is just a portion of the company. One of the huge issues is that it would not include reserves, and investors are having a hard time trying to figure out how to value that. What would you tell them?
Well, I would agree. There's a real contradiction there. I think maybe the way you bridge this is there's a strategy that the Saudis have to do a lot more refining of their own oil. At the current time, they refine a relatively small portion of that, but there's a big value added to be had from the oil production if you do more of it on an integrated basis. And this
that's not
idea
a quick process, though. It takes some time to be able to build up the refineries, right?
Oh, it will. Absolutely. This is going to take quite a bit of time, and that's probably why the percentage they're talking about is fairly small, single-digit percentage to be sold. And they're talking about listing on the Saudi market, which is a thin market. So there's a lot of work to be done by the bankers. That's why it's still a year away. I think it is significant that they've signaled they'll do it a year sooner than they were talking about, and they've made some decisions about the banking team and so on. So all of that points to moving ahead on this. But I think the real definition will come out probably late this year, going into next year.
Tom, we've also heard that Saudi Arabia just took out a big loan and that it's considering sovereign bonds as a way of kind of raising some funds in the meantime. Does this tell us that they are going to be really stiffening the resolve when it comes to not cutting deals, not letting Iran maybe get away with some things that they might have been able to do in the past in terms of saying who's going to produce how much? It's just their way of saying, look, we're in this for the long haul and we want to chase out any of those producers that have much higher costs.
I think that's a fair conclusion, but let's remember a lot of this is the theater of it. $10 billion doesn't really close the gap. We're talking their numbers would say $100 billion of deficit, but it does signal, look, if you want to try to outlast us, you're going to find it difficult.
What do you think just about oil prices? There are people now who are speculating that maybe we've stabilized somewhat. Other people saying, look, we ran up far too quickly in oil prices, and we could test those lows of the year back at $27 a barrel. What do you think, just given the geopolitical situation?
I think, first of all, we overshot on the downside when we penetrated $30. So some of that recovery, sharp though it was getting back into a more normal adjusted price. I also think we're going to spend the bulk of this year, maybe going into early next year, actually seeing enough of a decline in North America and China and other non-OPEC sources where by this time next year, most of the surplus, if not all, will be eliminated. But we still have to then pull down those inventories. So the view that it's going to take this year and some of next year to get us back into a new normal is correct. But that doesn't rule out the possibility that we could see somewhere in the mid-40s to the low 50s as we close this year. I think that's a reasonable expectation. The new normal that I'm looking for, 65 to 80, I think is out there probably in 2018, thereabouts.
Thank you for joining us today, Tom.
Pleasure to be here.